All right. Good morning, everybody. My name is Marissa Christensen. I'm the Executive Director of the Climate and Wildfire Institute, also known as CWI, and welcome to our insurance webinar, Ensuring Resilience, Pathways Through California's Wildfire Insurance Crisis. As you can see by the slide next to me, we have a really esteemed panel lined up today who I think will give us some really important insights on how insurance is functioning now and where we might be able to go. Before we dive into that and them, I will give you a little bit of a background on CWI for those of you who don't know. CWI was formed in 2021 to accelerate solutions to this era's most pressing climate and wildfire challenges. Our goal is to create faster and smarter solutions, linking together practice to research to policy to counter catastrophic wildfire and other impacts of climate change. We do that through collaboration and with many of you under a consortium model. That means we are what we are and where we are thanks to our partners across public, private, nonprofit, tribal, and academic sectors, some of whom are here today and some of whom are going to be speaking. So as you listen to today's panel, if you come away with a thread you'd like to pull and are looking for partners or resources you need to do so, please see us as a potential partner, a potential resource, and a connector. Our primacy in the wildfire space is serving as a convener, bringing people together to share information, forge new partnerships, identify priority challenges. And today's conversation is definitely an extension of that. This is intended to spark dialogue, maybe surface some new considerations, explore solutions together, and hopefully set the stage for further collaboration and action. So we want today to be more than just taking in a conversation, but interactive and hopefully inspiring. So thank you again for joining us for yet another one of our webinars. It is you here today that makes these webinars purposeful and effective, and we appreciate you all taking the time to tune in. Before we get into the meat of it, just a couple of housekeeping items. We're joined here by my CWI colleagues, Sarah Caldwell, Helen Lahota, and Sabrina Goodman, who are all helping behind the scenes. Sarah is going to be sharing some relevant resources and links in the chat throughout the session as it comes up. So please be on the lookout for some of those. And we encourage you to submit your own questions through the Q&A function on the bottom right-hand corner of your screen. We will answer as many of these questions in the last 15 minutes or so. And if we don't get to your questions, we are happy to get them at info@climateandwildfire.org. And we will look into getting you a response. So with that, I will give you a little context. As I mentioned, one of our primacies in this space is convening. We hold an annual convening, and that happened earlier this year in March. And one of the workshops that we hosted at that time was on insurance and risk modeling and how to get mitigation calculated into insurance availability. Our initial theory of change was that we needed to start a number of pilots, some of which have actually gotten off the ground and made some progress, in hopes of demonstrating efficacy of mitigation and getting some insurers who were willing to play ball and be a part of those pilots, thinking that if we could get a few of them, then others would join. Feedback since then has suggested that maybe that approach isn't the most effective, and broad adoption among insurance is a little bit more of a challenge and a longer road than just sort of demonstrating efficacy. And you'll hear a little bit more about that perspective from some of our panelists here today. Our panelists will weigh in on their perspectives on the very question of what is it going to take to get insurance companies to come along in their own risk modeling and considering mitigation. The question at the crux of today's conversation is, what do we need to do in our collective quest to reconcile wildfire risk with insurance access? With that, we're joined by a distinguished group of speakers, including our moderator for today's panel, Nuwantara Key. She is a seasoned leader with nearly 20 years of experience in climate adaptation, mitigation policy, climate finance, urban and regional planning, and social and environmental equity. In her current role at California Forward, Nuwantara supports the organization's overall strategy and program development, advancing initiatives that strengthen climate resilience across the state and well beyond. With that, let's dive in. Nuwantara, I will hand it to you to introduce our panelists.
Thank you, Marissa, and thank you to the Climate and Wildfire Institute for hosting this important conversation. It's wonderful to be here with you and everybody else on the panel. As mentioned, I'm Nuwantara Key, Executive Director of Programs at California Forward. And for those who may not know us, we are a statewide organization working to build a new California economy that is inclusive, resilient, and sustainable. And central to that work is the recognition that anything we are doing on our economy has to incorporate climate, both the energy transition and managing transition risk as an economic issue, but also, and importantly for this conversation, really understanding and managing the economic and fiscal impacts of a changing climate to California's communities, to our economy, and to our public budgets. So really excited to be here with such an amazing panel of leaders, and we will dive in here. So I really appreciate your framing, Marissa, and the point around kind of how do we move from pilots to scale and really thinking about the broader system change that needs to happen and the role of insurance and insurers in that kind of broader system and continuum. And one of the things that we have been working on at California Forward is thinking about kind of two pieces that I think are going to be themes that come up and through the conversation today. One is, how are we thinking about improving underlying insurability in communities? And then the second is, how do we make sure that those investments in improving insurability, reducing risk, are then translated at scale in how insurance and insurance providers are thinking about availability and the underwriting and really better managing how we're assessing the mitigations that are implemented on the ground. And as you teed up, there are challenges in how we do that at scale, but there's also a lot of opportunities and solutions out there. And luckily, we are joined here with a fantastic lineup of speakers and leaders to really showcase examples and help us think through how do we start moving this work forward kind of at scale and consistently across the system. So with that, I will introduce each of the speakers here briefly, and then I'm going to hand it to them to do a series of lightning talks. And then we will move into kind of a moderated discussion from there. So I'm thrilled to be introducing, to start, Carolyn Kuski, who is the founder of Insurance for Good. And Carolyn is also the Associate Vice President for Economics and Policy at the Environmental Defense Fund and a Senior Fellow at the Kleinman Center for Energy Policy at the University of Pennsylvania. She is the author of Understanding Disaster Insurance, New Tools for a More Resilient Future. And if you haven't read it, I highly recommend it. It is a book that I keep by my desk and reference often. So one of my favorite reads, I will say, and really very excited to also be working with Carolyn and really have strong partnership there between Insurance for Good and California Forward. We are also joined by Joe Nordlinger, who is CEO for Napa Community Firewise Foundation. And Joe brings a powerful combination of wildfire preparedness and business acumen to Napa. With over 22 years more of experience, he is chairman for Fire Safe Council, a volunteer firefighter, and longtime Napa County resident and landowner. And Joe brings with that a unique perspective to wildfire resiliency that really couples private sector solutions combined with fire safety expertise. And then we also are joined by Dave Jones, who is the Director of Climate Risk Initiatives at UC Berkeley Center for Law, Energy, and the Environment. And Dave Jones served as California Insurance Commissioner from 2011 to 2018. I had the privilege of working with Dave Jones in state service and appreciate his continued leadership then and carried through, both in terms of thinking about the important role of disclosure and the really getting a handle on how we are thinking about managing risk through tools like disclosure, but then also his leadership around really making sure that as communities are investing in risk reduction and resilience, those are recognized and carried through insurance. We also will be joined, and I'm not sure if he's on here, but Joe Engler, sorry. He is logging on now. So he is the CEO of Rockrose Risk, and he is an experienced executive with 2 decades working in InsurTech. As the founder and CEO of Rockrose Risk and Kettle Re, he's helped to build one of the largest wildfire parametric insurers on the West Coast. And before Kettle, he was the head of digital for Agro Group and started his career at Allstate Insurance. So with all of those introductions, I'm going to hand it now over to Carolyn to kick us off.
Great, thank you. Thanks so much. It is really wonderful to be here with all of you and to be having this important conversation. So I'm going to open us up by talking about some policy reform suggestions, broadly looking at wildfire and insurability in California. So I'm going to start with just a little bit of background for listeners who are newer to this topic. I think in some ways you could say that the California property insurance market has been in a period of high stress going back to the 2017 and 18 wildfires, which in some ways were a bit of an eye-opener for the industry. Milliman estimated that insurers paid out claims in those 2 seasons that wiped out over 30 years of cumulative underwriting profits for the state twice over. So it was a big hit, and it led to a bit of reassessment of insurability around wildfire risk in the state. So in response to that, we saw insurers start to withdraw from high-risk areas, non-renewals went up, forced place policies went up, which is when banks have to put insurance in place for people, a symptom of a stressed market, and premiums went up. And in recent research with a colleague, we've seen that the declining availability and the higher prices have started to have spillover impacts into housing markets. So using detailed home loan application data, we found that in areas of a high level of insurance non-renewals, the volume of home loan applications went down. People were less likely to move into those areas, and people in those areas looking to leave started looking at safer homes in response. We also see that as insurance prices go up, it's unsurprisingly capitalized into home values and home prices declined. So this really just confirms what observers are well aware of, that stress in insurance markets influences people's location decisions and is capitalized into housing markets. We also know from research that insurance is an absolutely critical part of our disaster safety net. Those with insurance have been shown to recover better and faster. They have fewer financial burdens in the short and long run. They have fewer negative financial outcomes. A colleague and I have found that there are community spillovers here too. As more households in a community have insurance, we see visitations to local businesses go up after disasters, because when you have the insurance you need, you can more quickly and fully participate in your local economy. We see that lack of insurance widens income inequality post-disaster, and looking beyond the household, insurance provides protective benefits to lenders and the mortgage market. So all these broad benefits are why it's really troubling when people can't access the coverage that they need or afford the coverage they need. So to be clear, though, insurance market outcomes like pricing and availability are driven by many factors, and some of them are beyond the reach of communities or the state. So for example, macroeconomic conditions really matter. Our prior period of high inflation, for example, and the labor and supply chain disruptions from COVID all led to increasing insurance premiums across the entire country, right? And now concern about things like tariffs and immigration policies and inflation again, all of those things that might make rebuilding more expensive would mean higher claims, which means insurers demand higher premiums. Some things, though, are much more within the state's control. The regulatory environment clearly matters. In California, in the recent years, though, we've seen some positive shifts in this domain from my perspective, with the Department of Insurance allowing reinsurance and rating, because reinsurance, which can diversify risk globally, is critical for ensuring catastrophic risks, and allowing cat models and pricing, which again are critical because in this environment of growing risk, looking backwards at historical losses is no longer an indication of the types of events we're going to see going forward. So all of that should help California be a more attractive place for insurers, increasing availability and competition. And yet, we are in a period of ever escalating risk, right? Risk is not stabilizing at some new plateau. In failing to aggressively curb emissions, we are locked into growing risk. And those growing risks are going to continue to stress insurance markets. Recently, a couple colleagues and I discussed the ways in which climate change is thus threatening insurability. And we see it in changes to the loss distribution at both ends. Some events are becoming much too frequent to insure or to cost effectively insure. And at the other end, very severe events are getting more severe, and there's more uncertainty in the tail of that distribution, which again breaks the math that underpins our insurance markets. As such, and to come to some of the conversations today, I really think that the only long-term solution to stabilizing insurance in areas of high and growing risk is through substantial investments in risk reduction. So this past summer, when I was asked by the Blue Ribbon Commission around Rebuilding LA to provide them with some insurance policy options, that was a key topic that I wanted to focus on, was creating insurable communities, as New and Tara teed up. So we also need to do other things, reform the FAIR plan, create more inclusive markets. I don't mean to minimize those, but in the last couple of minutes I have here, I want to focus on this insurability piece. And that sometimes means leaving insurance to stabilize insurance, right? Instead of insurance market changes, we might need to be focusing on where and how we build. For instance, I think we need to expand the scope of wildfire building codes to account for urban fires. And in some joint work with Headwaters Economics, where we were costing complying with different levels of wildfire home hardening, comparing to the benefits, which, as I'm sure everyone's aware, wildfire home hardening is incredibly cost effective when you think about the savings, not just to the household, but to the broader economy at large. But what we found was that strong building codes go hand in hand with strong insurance regulations. So California requires code upgrade coverage of 10%. So when your home burns and you go to rebuild, if you are under a wildfire code like Chapter 7A, your insurer has to pay to help you upgrade to come into compliance with that code. But for example, in parts of the Eaton footprint where that is not code, people have to pay for those improvements in wildfire resilience themselves out of pocket. And post-disaster, lots of families are incredibly financially stressed and don't necessarily have financial bandwidth to be paying for greater investments. So strong codes can unlock insurance dollars. We also need to do more to educate people about what safe building looks like, things like standards and measures, the IBHS Wildfire Prepared Home Standard. We need to develop robust funding and financing strategies to pay for all the upgrades that we need to do and the retrofits in light of changing risk. And that's why I'm really excited that Insurance for Good is partnering with California Forward on this challenging topic, because we know that avoided losses are difficult to turn into cash flows, and we know that insurance can't finance and fund all the needed investments in risk reduction either. And yet we have to be doing more to bend the loss curve. I do think there are ways insurance can help, and this is where I'll wrap up. We've recently completed a report on insurance endorsements for climate-ready rebuilding that similarly would give you extra dollars at the time of rebuilding to go above code when it's going to substantially lower losses. We think that needs to be coupled, though, with a lot of education and outreach and help navigating that challenging process. And finally, we're starting to see some home hardening show up in the insurance market. So a few years ago, DOI required insurers to offer discounts for certain home hardening and community fire resilience measures, and those are now rolling out, and we're seeing consumers be able to access them. So to end, I think with a unified effort, we can hopefully start to build safer homes and communities that can be insurable in the face of this growing risk. So thank you again for having me, and looking forward to the conversation.
Wonderful. Thank you so much, Carolyn, for providing such wonderful overview and quite a number of things here that I know we will continue talking about. I'm going to turn it now over to Andrew from Rockrose Risk to kind of give a perspective from kind of on the ground underwriting and sharing some examples of kind of mitigation success from there. So welcome, Andrew, over to you.
Thank you, guys. Keep me on time too, so give me a virtual kick under the table. But look, I'm going to jump straight into it because we don't have a lot of time, but I get to jump straight into really exciting news. If I had been talking at this forum 5 years ago, maybe even 3 years ago, I would say we are in a very different spot than we are today. Insurance companies afraid to recognize mitigation, having no idea how to quantify it, and honestly, just completely scared of the market wanting to exit. As of now, in the last month alone, we had ended up starting a new company called Rock Rose, which is an insurance broker, a retail broker that helps people get mitigation discounts. So Insure gives back money for them doing mitigation. Last month alone, we covered $200 million in property. The average discount given was 35%. We had two major HOAs, one in Incline Village in North Lake Tahoe and one in Aspen, Colorado. And to give you an idea of the picture, I just saw it in the Q&A. It's a great point. Insurers are incredibly intelligent. We may think that they are dumb or that they're evil. They're not. They're actually just a bunch of humans trying to do their best to do a job, make sure they don't lose that job, and make sure they don't lose a ton of money. Where the rubber needed to meet the road is an understanding of what mitigation works, how much does it work, and how much money should we give back. So an exact example like an Incline Village. You had an HOA that was paying $250,000 a year, call it, 2 years ago. That insurance went up to $1.3 million a year for 100 million in coverage. As you can imagine, it was about 200 unit HOA. That was a significant increase to the entire population base of that HOA. We came in, put together a 40 to 50 page risk report. The real important part here is there is an insane amount of good done at the community-based level by North Lake Tahoe, the Tahoe Fund, Amy Berry there, multiple groups, Chief Summers. And so we take a macro approach first, like I think was said. You have to do the wider region where you do a larger fuels reduction. That is the first part any insurance company is going to look at and say, has the larger community done something? Then once that larger community had done something, call it, zip code, larger county area, we're able to focus now on individual properties, mostly HOAs in the areas, and we'll get to residential down the road. But these larger structures, larger commercial, that we could say, look, if we can talk about one, how much money they've already spent, call it 100,000 plus on their mitigation, either doing fuels reduction, hardening, closing easements, changing out roofs, changing zone 0, which is probably the most critical. Can we talk to you insurers and have some sort of discount so we can incentivize them to do more work? And right now we have 16 carriers behind us that give us that average 35% discount. So I can tell you it's not more of like a pie in the sky dream. And while I'd love to say, yeah, we're able to do this across the board for every state on the West Coast, it isn't that way yet, but this is the most important way you change a system, which is hardcore, factual, evidence-based examples that we can say, here is a community. This community did a significant amount of reduction at cost X over time, and it's going to cost Y each individual year. We have each individual property that took their responsibility. They reduced the risk. And what we were able to do is come back with a very simple calculus to the insurer that wasn't even like a goodwill. It was us telling them, frankly, guys, if we were to give back $300,000 to the insured and they spend $100,000 of it next year on mitigation, we can prove that this lowers. If you're insuring $100 million building, this building's probably going to burn down, for example, once every 30 years or once every 50 years. If we can reduce that to once every 100 years with that $100,000, that is an incredible savings in terms of the insurer. It gives money back to the insured to incentivize in the right direction. And even more importantly, most important part, we have a building that's not going to be destroyed, people that aren't going to die. And now it's a knock-on effect. It gets easier for every single person surrounding these buildings. And so I have a lot of, I think, love and respect for these first movers that are saying, yeah, we're willing to do the work. We're willing to work with people like ourselves. There's multiple other companies stand out there, a lot of good people, but I'll leave it at that. We're at a very different point now, and we are seeing significant change in the market. And I would really recommend you just reach out to anyone talking about it, myself, and I can recommend, and also be vocal about what you're doing and what's working.
Great. Thank you so much, Andrew. Lots to dig in there and lots of follow-up questions around that when we get to the discussion portion, but I want to turn it over now to Joe for your perspective here, really from kind of providing a landowner lessons learned. So over to you.
Great. Thanks for having me on the panel. I'm happy to share some of the things that we're doing in Napa. So as you mentioned earlier, Nuantara, my background is sort of private sector. I had the opportunity to take over and sort of rearrange how Napa Firewise works as an organization. In Napa, we've suffered from 5 major fire complexes that burned about 65% of the county. And so early on, what I did in 2017 was to take the organization, restructure it, and turn it into sort of a shared services model where we could drive structural efficiency that gave us some advantages. And those would be principally making sure that as a county, we don't have, 19 different nonprofits that are all doing bits and pieces of wildfire resilience. We essentially consolidated everything so that Napa Firewise is sort of the shared services hub. We do all the grant writing, all the grant application, all the environmental compliance, all the finance, legal, HR, all of the sort of core services that are required to pursue an integrated strategy around wildfire resilience. And that means that our 22 fire safe councils, 18 of them are Firewise designated. They can all focus on their highest and best use, which is to give us good connective tissue into the community, understand their prioritized projects, and then just systematically deliver on those. So at scale, we've delivered on thousands, coming up on 5,000 acres of fuel reduction, hundreds of miles of county roadside clearing, hundreds of miles of dozer containment line maintenance and improvement. All of our work is in a maintenance regime, so we understand how to sort of look after it and ensure that the stuff doesn't fall into disrepair. As we all know, these things grow back. We have 2 main programmatic functions. One is all things fuel management, that includes our containment lines. The other is all things wildfire preparedness, which includes things like defensible space cost share, and all of our outreach, education, et cetera. We early on, and this is sort of my private sector brain thinking, we wanted to consolidate, create an efficient platform. We also wanted to make sure that we understood the market. So we very, very quickly identified the totality of what the cost would be to achieve comprehensive resilience. And then we focused on sort of segmenting our audience. And we understood that there were 5,141 parcels that were in the high or very high severity. We started to design very specific programs to get those folks the defensible space cost share assistance that they would need, as well as just the education around how to think about wildfire resilience. So we've tried to organize Napa Firewise, thinking about it as like a vertically integrated services platform that understands who our audience is and who our customers are, and then can basically scale out services and deliver what's required for these folks to make these resilience investments. We then sort of really looked at large landowners in rural areas and smaller rural landowners that abut suburban communities, and recognize that these are folks that are out there. Many of them are making substantial investments in resilience. They're generally doing it not necessarily with the right prescriptions, prioritized the right way, and they're generally getting massively overcharged for this work. So we've basically scaled out our fee-for-services capabilities so that we can advise landowners to make these investments intelligently and to get the right pricing for them. And then most importantly, that the information is captured and it can be leveraged from the standpoint of improving wildfire containment. This is, I think, a big missing link that I see out there. In communities where you have lots of different entities working on this, there is no sort of comprehensive cohesive effort. And worse yet, these projects are being done, whether large fuel mitigation projects or whatever, they're being done and they're not really being leveraged and integrated into wildfire containment strategies. So we've essentially undertaken an effort to work with lots of landowners at scale around the county, and we've focused on the most topographically strategic locations that have the best opportunity to work on fire containment. We work with those landowners, we help them to do the work that's required. Then we make sure that we map all the resilience attributes, access and elements, et cetera, so that they can be integrated into fire response digitally in the system that is used throughout California now. It's called Tablet Command. So at its sort of core, we're really trying to make sure that we deliver on that sort of resilience value spectrum, and that we're working with landowners to make sure that the work that they do is done effectively and that it can be used to drive containment operations. All of that ultimately allows us to contextualize risk for insurers. And so we work with it's about 40 different carriers that we're working with, socialize this concept, the standards that we've developed, the taxonomy with CAL FIRE, so that they understand where this work is taking place and why these locations are strategic for wildfire containment efforts in an actual incident. Happy to talk about this further in the Q&A portion, and folks have, questions outside of this forum, happy to field them and share information about what we're doing.
Wonderful. Thank you, Joe. So important, the work that you all are doing to really bring that those pieces together on the ground and really get this work moving at scale. So appreciate that. And now I want to turn it over to Dave, for you, Dave Jones, to talk about some of the work that you've done to successfully design and place wildfire resilience insurance that incorporates mitigation. So over to you.
Thanks, Nuntara. And let me just check to make sure folks can hear me.
Yes.
Terrific. Well, thanks to the Climate and Wildfire Institute and my co-panelists. A real privilege to get to spend some time with you. And I'm going to talk about a partnership between UC Berkeley's Center for Law, Energy, and the Environment, the Nature Conservancy, and Willis Towers Watson, which is a global broker and risk advisory firm. And I'll spoil the ending, but we were successful in placing an insurance product smack in the middle of the forest in Northern California for a large homeowners association. And the insurance product was written because we were able to demonstrate that landscape scale forest management reduces risk. So just for those that might be new to this subject, I think it is important to underscore that we have a lot of science around Western forests, what makes them healthier and what helps to reduce fire risk in Western forests. And the short version of this is if we manage our Western forests the way that nature used to manage it, where fire was a routine part of the ecology, where fire burned out lower level vegetation and ladder fuels, our forests were characterized by a lot more open space, and the wildfire severity was a lot less. Well, we've had 150 years of fire suppression, genocide against Native American peoples that used to engage in cultural burning, and now our forests are choked with fuel. The good news is that the federal government, the state government, local governments are all in various ways investing in landscape scale forest management using prescribed fire and thinning and other fuel reduction technologies. It's good for the forest. It's also tremendously important in terms of reducing wildfire risk. So the problem we set out to try to solve in 2020 with this partnership was the fact that at that time, insurers were not taking into account landscape scale forest management in the modeling they do for pricing and for underwriting. In fact, underwriting is even more important because as we know right now, pricing matters, but just getting the insurance is even more important. So the problem we set out to try to address was the fact that the models that the insurers are using for risk scoring and for pricing didn't take into account the proven risk reduction benefit of landscape scale fuels reduction. So the first way in which we set about doing that was we took some fire behavior science associated with a landscape scale forest management project that Nature Conservancy was doing in Placer County, and we moved it into insurance modeling. And we demonstrated that, in fact, the models that insurers use, whether they're proprietary models or they're vendor models, the models they use to set prices and to decide whether to write or renew insurance underwriting are technically able to take into account the risk reduction benefit of landscape scale fuel reduction or forest management. And we published a paper in 2021 where we actually exposed the formulas of the models that with some adjustment, we're able to then allow the models to take into account the risk reduction benefit of landscape scale forest management. And the good news was you don't have to actually write new code for the models. You can actually adjust the formulas to the models. And what we found was that the insurers actually saw a benefit in terms of a reduction in their losses by 20 to 40% in terms of modeled average annual losses. And that's a big deal for those of you that are in the insurance space. So the next step then was we published those results, and our hope was the insurance industry would take them up. That didn't quite happen, but the good news was that those results were replicated separately in a paper that Moody's RMS, the big insurance industry cat modeler, published about a year later, and no one argued with our results. And so that was a terrific outcome as well. And their results showed the same thing. So what to do next? So what we decided then as a partnership was to see if we could actually place an insurance product that was written directly because of landscape scale forest treatment occurring in the geography in which the insurance was written. And just to cut to the chase, because I only have 5 minutes, we did it. We were successful in placing an insurance product for a homeowners association in Northern California, the Tahoe Donner Association, a 6,500 home community across 7,500 acres of forested land in Truckee, where there's quite a bit of wildfire risk, but also there's a substantial amount of landscape scale forest treatment going on, both because it's happening in the U.S. forest, the Truckee Fire Protection District is doing it, and the Homeowners Association is doing it as well. And what we're able to demonstrate to the insurer, without having to do additional fire behavior modeling or an additional actual run of the insurance modeling, with a little bit of risk analytics in the area showing the behavior of fire, was to demonstrate that the landscape scale forest management occurring in and around that area would dramatically reduce their risk, and that they could write this insurance policy in a geography where, frankly, other insurers are not writing insurance, are not renewing, and are declining to write at all. And so the insurance is what's called a parametric insurance product. It pays out based on a wildfire event occurring. It provides $2.5 million of coverage. It covers about 1,350 acres. And if any of those acres burns, then the insurance pays out. And it also pays out based on severity. Why? Because low severity fire actually is good fire. We want the fire to stay on the ground. We want low severity fire. So the insurance pays out slightly less per acre for a low severity fire, but for high intensity fire, it pays out fully. And the nice thing about a parametric insurance product is the Homeowners Association can use that money to restore that acreage or to basically restore structures. They have complete flexibility with regard to how they deploy that resource. Now, again, the top line was that the insurance was written at all. The insurance underwriter and capacity provider was Liberty. The actual company in front of that was Globe Underwriting. The broker was Willis. And again, they wrote it in a geography where others are pulling out. But for good measure, we also got a 39% reduction in premium and an 84% improvement in deductible, just because the product took account of the landscape scale forest management. So I think, the good news is that as Andrew and Joe and Carolyn have spoken to, we have seen a number of terrific examples in California where insurers can actually account for landscape scale forest management, but for good measure, community fuels reduction of the type that Joe's talking about and Andrew's talking about, and then property hardening as well. It can be done. We just need to see more of it. And I know we're going to get into a deeper conversation about that. But I think what we've demonstrated now is this is doable, that insurers can write this product, that can take this risk reduction into account, and we urge them to do so.
Great. Thank you so much, Dave. And thank you, yes, to all of our speakers for those very on time, rapid fire presentations here. And you all did an amazing job of getting so much out here. And I'm really excited now to turn to discussion and for us to dig in a little bit more. I think one of the things that I really appreciate that each of you kind of mapped out from different perspectives and from kind of a different vantage point is that when we're talking about insurance and kind of the issues in California here today, but just broadly, as Carolyn, you were talking about kind of examples from around the country, we're not just talking about insurance in isolation, that insurance is part of this broader kind of system. And as was said, kind of this resilience value kind of spectrum. And so what I really appreciate from each of you is kind of talking about where and how there are opportunities to improve underlying insurability. Carolyn, to your points that you made, that it's, fundamentally about kind of the underlying insurability of communities, where and how we grow, the important role of building codes. And then also a number of you have talked about kind of the education piece, both the community education, getting the right partnerships aligned and working together at scale, but also then the kind of education and capacity building that happens within the insurance industry itself to learn how to better kind of understand the value and benefit of mitigation efforts and investments on the ground, and then the work that it takes to actually, from a technical side, get that built into the underwriting and pricing kind of structure and decision making in insurance. So I really appreciate this conversation and kind of the view here that you all have mapped out that is kind of a really comprehensive overview of the different pieces that need to come together. And so really appreciate that. And I am going to open up now for our first discussion question here. A number of you spoke to this issue of kind of what it takes to kind of catalyze that initial action on the ground, or kind of catalyze the work that we've been talking about here today. And I'm wondering if you could kind of share from your view, and we can go into a little bit more detail, like what was it that when communities are making investments in risk reduction, kind of what is that first catalyst that you see to carry success of those getting those investments recognized through into kind of insurance underwriting and or pricing? And so maybe I might turn, Joe, to you for your perspective first on this question of kind of proof points showing that mitigation measurably changes insurability and what that first catalyst is to doing that from your view.
Sure. So we, I think early on recognized that there was this gap, which is, we were doing all this work around the county, and we just fundamentally said there's got to be a way to better build this nexus to insurance outcomes. We actually convened. We worked closely with CAL FIRE. We went out and socialized some ideas with a bunch of insurance companies. We convened a focus group of 13 large landowners here in Napa County and essentially said, hey, we've got some ideas. We'd like your perspective on them. We'd like your ideas to improve these ideas. And if at the end of this conversation you think that there's a there, then we're likely going to ask you to contribute financially to this. What we've sort of largely determined is there are 3 different kinds of landowners, and I think this holds true in most counties. It's just the proportions of them. We have about a third of our landowners are pretty wealthy. They have large properties, and they've done a tremendous amount of resilience work. They've made big investments. Nobody knows about it. Then there are like a third of landowners that have large properties. They've made large investments, or they've made a strategic decision to just focus on defensible space and home hardening, but they're not doing large scale fuel mitigation. Why? Because they're basically asking a simple question. I don't know that the fire is going to come from that direction. I don't know what my neighbors are doing. I'm probably wasting my money spending it on that 80 acres of forest. And then there are landowners that are property wealthy, cash poor. They've got a lot of generational wealth tied up in the land at a low tax basis. They might have a really strategic property that has a very important strategic dozer line. They're living on a fixed income of $100,000 a year. They don't have the means to spend any money on this work. So in convening these landowners, we were able to figure out how to optimize a mix of donated dollars, grant money that we control or influence, and then landowner fees, helping them to make these investments on their own. So that catalyst, I think, allowed us to then say, great, let's press ahead. We're going to start to build key resilience areas based on topographical significance that requires the input of CAL FIRE, Napa County Fire, the fire districts. We identified those locations, identified hundreds and hundreds of landowners who have strategic properties with critical resilience elements, that many of whom have made investments. And it was really that sort of impetus that allowed us to then say, we think there's an unlock here. Let's go socialize with this with insurers. And insurers said, yep, we think that, if you can define these things, then that has value. Last thing, we have about 4 examples now, it's early days, of actually doing this work, and then that resulted in substantial reductions in premiums, in some cases hundreds of thousands of dollars for a large landowner, 25-50% increases in coverage, one case of somebody getting off the FAIR plan. But I'm a data person. I want 20 data points before I can say we've got like a substantial, meaningful, sustained trend. But even directionally, if we can improve the insurance outcomes of 20, 30, 50, 60% of these people, I think we're moving the needle. Hopefully that answers your question.
That was great. Yes, no, appreciate that. And we're going to come back to the kind of the data piece and that point where you landed around kind of what it means to be working at scale and yeah, we'll come back to that in a second. But I wanted to see if Andrew or Dave, you wanted to share anything around kind of from your view, kind of that first catalyst point that you all have been speaking about here today.
Yeah, I'll take a shot at it first. Look, I think the most important thing is it has to come from a logical standpoint. These are underwriters a lot of times sitting in woods of London that, are pretty far removed from California or Colorado. So taking things like fuel reduction, where we can say, look, there's a fire triangle, fuel, heat, oxygen. If we remove one of those elements, we significantly reduce it. The other thing is we've had incredible partners. I recommend checking out like burnbot.com and Wildfire Services by Joel Holland, and taking these ground level assessments, taking this data that they're taking, which is like, okay, we can get some sort of quantum of information. What is the vegetation index in this area, or what is the NDVI like for this area? Can we get a satellite image from 5 years ago from today? and show some sort of delta or difference between that. And now here's the one benefit about like our current horrible situation. Everyone's prices have been raised 400%, which gives you a lot of room to work with to go back to an insurer to say, hey, if I can get $20,000 back, that's a significant amount of work. And I compound that between 5 different, homes, communities like in this area. That's a significant amount of work that can be done, which means a lot that can move the needle. And so what I'd say is you have to work with like the people on the ground to start to aggregate that information. And then you have to think like an insurer, which is they are always thinking in terms of return period. How often is something going to happen and how bad is it going to be? And so we can naturally always take the first one, which is I can look at a map and say, how often has this place had a wildfire hit it? And what did it look like? How bad was it? There's going to be some correlation between what the future looks like. Now, it's probably going to be worse in certain areas, might be better in others, but some amount of information we can gather from that. And then taking a very base logic statement. So like in Aspen, if this area has been hit 2 times in the last 50 years, how bad did those fires look and how much was this property affected? Can I get to some point here where I say, look, we understand that fuel is a critical part of this fire triangle. If I can reduce the fuel in this area and show, hey, here's an example that this is what it looked like before and after pictures. Here's what Modus and Veers were showing before and after. You can start to get actually some sort of meaningful discount. And then what you want to do is just use actually economics, free market, and go to the first person and go, look, can you give a 10% discount for this? And they're going to go, yeah. By the way, insurers want to write business. The last thing they want to do, like any public company, is shrink and go away from the 5th largest economy in the world, like California or Colorado or many of these states. So then it just becomes going back into a regular system of multiple people saying, yeah, I think this is a better risk than everything else. I want this risk more than my competitor. I'm willing to do some competition and pricing there. And it starts that simple and gets you back into a more stabilized market from that point.
Great, thank you. Dave, I'm curious from your view, what we should be amplifying here to build that confidence that you talked about kind of between the kind of communities and the insurance pricing at the landscape scale.
So I think for us and for others on this call, the first step was science that showed that landscape scale mitigation actually reduces risk. And there's also been a similar concomitant increase in empirical and scientific work around property mitigation and community level mitigation led by the Insurance Business and Home Safety Institute. So, starting with the science is critically important, but then partnering with a broker, as we did with Willis Towers Watson, and then moving that into insurance modeling. So it wasn't just, here's the science, but does it actually move the dial in terms of insurance modeled outputs, in particular average annual losses, such that in fact it can be structured and priced based on the risk reduction. So that was a critical part. And then publishing those results in 2021, and then, engendering a similar paper by the insurance industry's big modeler, and then moving forward and placing the product. But I think the frustration that many Californians have right now is, despite these very promising pilots, it is still the case that you could be a homeowner and do defensible space, do home hardening, live in a community that's engaged in fuels reduction, be adjacent to a U.S. forest where CAL FIRE and the U.S. Forest Service is doing landscape scale fuel reduction, and you still get no credit for it in the risk score that the insurer is using to decide whether to write and renew your insurance. Now, if you can get the insurance, you get a discount because of a regulation enacted a couple of years ago by the Department of Insurance. But the bigger problem is getting them to write the insurance now, given what's happening with regard to background risk. And I think, we should talk about that, because that continues to be a frustration. I think each of us has shown in various ways that these sorts of mitigation measures at the property, community, and landscape scale can and should be accounted for, but it's just not happening routinely and uniformly with home insurers and small business property insurers in the state of California, or throughout the West for that matter.
Great, thank you, Dave. I think that's a great transition. Maybe Carolyn, I'm going to turn to you here, and Dave will come back to that too. But Carolyn, for you, I'm curious your view, if you wanted to talk about that IBHS wildfire prepared home standard, and just kind of bridge into this, like, what will it take to kind of get things at scale, as Dave was just saying. So curious your view there.
Yeah, I think Dave really hit the nail on the head with where we need to solve for, right? Because the challenge is residential insurance availability and pricing is really difficult. And we also hear from people and communities that they feel like they're doing a lot of resilience investments and they're not seeing the outcomes in the insurance market like they would expect. And that erodes trust in the market, but it also prevents like the positive reinforcement you can get when you have a financial incentive and an information signal about the risk reduction measure. So I agree that's where we need to be moving. We've been recently looking at all the rate filings of the top 15 insurers in California. It's 85% of the market. And because of the requirement a few years ago that you have to account for certain mitigation measures, they all do now to some extent, right? But I think, as we all know, doing one-off measures doesn't substantially drive down risk, right? You have to do packages of them. And so to see sort of real price change benefits on your policy, you have to do the whole suite of home hardening. And there's a couple community measures that are added there as well. Where we see the largest price discounts are for the IBHS Wildfire Prepared Home and Prepared Home Plus standards, which are sort of a comprehensive standard around home hardening and defensible space. And I think a nice thing for insurers is that it's easy to verify. You know what I mean? They have an evaluator who do it, and then it's kind of like, check, we know that this home has done all these measures to lower losses. We've also seen, though, to Dave's point, like, it's not just pricing, it's having insurance at all. And that's absolutely the fundamental question. And several insurers have now made statements in their rate filings that they're going to focus their business growth, any new policies, on wildfire prepared homes, and that they're going to kind of limit their new writing to homes that they can verify as being at a higher standard of wildfire safety. So now the challenge here, right, then comes back to retrofits, because a lot of homes are just not at that standard. It's going to be really expensive to retrofit them to that standard. And a lot of communities are not at a safe standard either, right, where we haven't been thinking about structure spacing and fuel breaks and all the things we need to create a kind of safe community. And you can't rebuild a community that's already standing there. So we do face some challenges on that front.
Great, thank you, Carolyn. I think, evolving from there, kind of this question of, okay, we've laid out a lot of challenges, but also, strong signals here and opportunities, kind of innovations that have happened. So now, kind of building from this, what do you all think it would take for insurers to, whether it's kind of adopting new kind of mitigation informed risk models, which is a piece of it, but you all have also talked about other pathways, which is kind of, Dave, to your point, it was kind of demonstrating that the science is there and then figuring out how to integrate that into existing kind of modeling approaches. But kind of, what do you all see as what it would take to really get the work that we've been talking about here today kind of implemented at scale across the industry?
Well, I'm happy to go first. So I think certainly socializing all of the work that is being done by Californians on home hardening, community, and landscape scale mitigation matters. The fact that CAL FIRE has an online searchable, GIS shapefile database of where the forest treatment projects are occurring. I think more federal, state, and local investments in landscape scale mitigation. I think standing up a grant program for home hardening for people to retrofit their homes to do home hardening. I think it's terrific that the industry is developing a community hardening standard, but I am very concerned that in doing so, they also seem to be messaging that individual home hardening doesn't work. More is better. Community hardening is better than just hardening your individual home, but there's an increment of risk reduction associated with hardening your own home. And I think you should get the benefit of that in the models they use for underwriting. A lot of your listeners and viewers may not understand that the insurance commissioner does not regulate underwriting. At best, insurance commissioners regulate rates, but the decision the insurers make whether to write and renew insurance is entirely within their discretion, and there's no regulation, nor can there be, associated with that unless a legislature decides otherwise. And what we're seeing in at least one other state is a high degree of frustration with the slowness with regard to the insurance industry, direct writers of home and small business property insurance taking up in their models these risk reduction benefits that we've been talking about, whether it's home hardening, community fuels reduction, or landscape scale fuel reduction. And what one state has just done, the state of Colorado, has passed a law requiring that the models used by insurers, not just for pricing, because we've talked about pricing is terrific, but getting a discount doesn't matter if you can't get the insurance written. So it needs to also apply to underwriting, that the models that are used for pricing and underwriting in that state will have to account for property, community, and landscape scale mitigation. And so that's one state that has decided, look, we've been waiting for a decade for this to be taken up voluntarily. We're making huge investments. Homeowners are making huge investments. Small business owners are making huge investments. We're not seeing any reflection of that in the risk scores. And so we're going to require you, insurance industry, to account for this. So that certainly is one path.
Yeah, one thing I'll add on to this too, and I think it feels so jarring that the system we're in today, because it's so different from what we've seen historically. Like, take for example 9/11. 9/11 was a massive, unexpected event. Never seen a terrorism event like that. $100 billion plus loss to insurers. Totally hit. And what happened the next day? The government steps in completely, says we are going to retrofit the entire infrastructure of air travel. We're going to create TSA, spend hundreds of billions of dollars and mitigate it. Same thing you see happen after Hurricane Katrina. Same thing you see happen after the Galveston hurricane of 1905. The difference is we haven't seen that massive changeover in infrastructure and adapting to a changing environment. And so what's different here is, normally I think we took it a lot for granted that these things would just happen after bad events or after, sudden catastrophes. And all of a sudden it's kind of been put back in the people's hands. And so we're at like a much better point, I think, now, where it seemed like a lot of people around the table, whether it was regulators, insurers, homeowners, civilians, firefighters, our house was on fire and everyone was still kind of pointing the fingers and going like, who started the fire? And now we're actually at this point of like, doesn't matter. The house is on fire. Let's figure out how to get out of it and like take out the fire and turn it off. And so in terms of like changing over a system here, I find it, I'm definitely not as talented as people like Dave, where I can actually do something on a legislature scale. And so I look at it from an economic and game theory standpoint, like was said in the questions of, you have to incentivize markets back by showing them that there is no pricing this risk. There's no way to price a risk that hasn't been mitigated, or a change in an infrastructure that is basically fatal. There's some core aspect of it that will cause it to keep failing. What can happen is you can start to incentivize people, these corporations that want to make money and want to do their job, and incentivize more of them to come back in these good spots. And what you do is you start to build out a base. And I think, one final point is, the biggest part we can do here is looking at how to do this work ahead of time and actually document it specifically with a FAIR plan. Because I don't know how many people recognize, but at the end of the day, a lot of the insurers I do talk to in like the higher level C-suites, they're not afraid of their own risk right now. They're kind of comfortable. They can say, I know how often Malibu gets hit. I know how often these areas get hit. They're terrified that actually the way FAIR plan works is, every single risk they say no to goes back into FAIR plan. And if they're leaving the state and the competitor next to them is leaving faster, there's a mechanism called an assessment on the FAIR plan. And when FAIR plan blows through all of its reserves and its reinsurance, it assesses every insurer in the state relative to their market share. So what you create is a situation here where if we don't fix how to mitigate these risks in the FAIR plan, and all of these insurance companies are all behind the idea of, we should fix these FAIR plan because we are going to end up paying for it. We will get assessed for it. There's a major loss. It is ultimately this great, I guess, circle where we can all look at it together and go, everyone's going to be on the hook. And by the way, they're also allowed to like now pass back the rate to people. So there's these examples, I think, where we can all look at it together and understand we're all in the same boat and still work in the same direction of getting more and more insurance competing against each other and making sure to take it out of the FAIR plan.
Great, thank you. Joe, anything?
Yeah, I would just add that I think so much to cover, very complicated issue, but at just some basic level, I think there's a need to understand we also exist in this world where policies are written for 1 year, right? And as a result, there's this need for re-verification every year, because you can pass your defensible space inspection or your LE 100, but the reality is you could then, so you sell your house, somebody comes in, whatever, basically you got to re-verify that every year. Somebody could stack a bunch of wood next to their house, they could do a remodel that creates fire vulnerability. So there's this need to consider the fact that all of this needs to be done on an annualized basis, which means at scale we're talking about hundreds of thousands, millions of inspections to really be able to make sure that everything is verifiable, and it feeds into that annual renewal process. And similarly, I think there's this need to think about common taxonomy and verification, ground truthing of data. There is, as Dave mentioned, there's a shared portfolio that shows where all sorts of fuel mitigation work is done. I don't think anybody trusts that data, because if that project was done 4 years ago, its value is pretty shaky. And so there's a need to understand this spectrum of mitigations, and then to make sure that to the extent that we're sharing data about that it actually is meaningful data that an insurer will look at and say, I trust that data. And I think this is kind of a critical element that Andrew sort of brought up. You got to think like an insurer. You need to think like an insurer. You also need to think like a firefighter. Where do we stop fires? We stop fires on ridge tops, spur ridges, wide open saddles, and benches. Fires are driven by terrain, fuel, and weather. And so we have to sort of understand, where do you generally stop fires? What is that topographical significance? How does it factor into resilience layers and buffering? Because in the end, you can have a community and you can do a perimeter fuel break, but you probably need to think beyond that fuel break to where's the nearest adjacent ridge line, or where's there a large staging area or saddle or a bench or whatever. And all that stuff factors into how quickly we can stomp out a fire, which I think is pretty important. We got to sort of orientate ourselves around more rapid containment as well. Just other elements to add on to the great perspective that Dave and Andrew provided.
Great. Well, thank you all so much for this. I think we're out of time here for this discussion portions, but because we really want to make sure we've got plenty of time to be able to respond to the questions that are coming in. So I just want to take one moment here and say thank you to all of the speakers here for this discussion and for really sharing all of your expertise here. So Marissa, I'm going to hand it back to you.
Yeah, thank you. And thank you to our panelists as well. We do have a rather large number of audience questions coming in, so we'll do our best to get through as many of them as we can. I am actually going to start from the bottom because I think some of our earlier questions were answered sort of as we went. So looking at one of the questions at the bottom here, are the policies that you all are talking about taking mitigation into account all non-admitted markets? And are any of the admitted market insurers changing their underwriting and pricing in significant ways?
I'll just quickly say that what I was talking about was only admitted carriers and their reductions for homeowners insurance policies and their underwriting around homeowners insurance policies. But I think some of the more innovative things you've heard are maybe not admitted policies.
Yeah, that's the easy one for us. Ours is all non-admitted at this point, just from the freedom that's allowed in it, but hopefully gets transferred into the admitted market over time.
And I would add that, hundreds of our residents have benefited from discounts because they're a Firewise designated community or they're in a fire safe council. That's largely admitted. Most of the sort of innovative work we're doing around these sort of resilience areas and investments working with landowners, I would say that 3 out of those 4 examples that I gave are non-admitted, 1 is admitted.
So the only thing I would add is that there is one MGA, managing general agent, called Dellis, that's writing for an admitted carrier in California, and they have a model that actually takes into account landscape scale vegetation management. And so they're actually taking policies off the FAIR plan because they're taking into account landscape scale mitigation. They're the only one I know of in the state that's doing that in the admitted market.
Great, thank you. I'm going to continue to sort of jump around here to all of you. What do each of you feel are the biggest data and resource gaps within the work you do for wildfire risk? And what data available do you feel needs upgrades or improvements?
I can speak to that in the context of sort of what, I think about not just Napa County, but the LNU, the Sonoma Lake Napa unit, which includes Yolo and Solano. And so from our standpoint, we think it's critically important that the work that we're doing is contextualized along with other counties' works, because fire doesn't care about your parcel boundary or your county line. And so we've been pushing very hard for a shared geospatial database that contemplates all elements of this kind of wildfire resilience work, but the critical thing being common taxonomy and common understanding. Things need to age out. You can have a project, if you did it 2 years later, I don't know that project should be listed, or if it is listed, it needs to designate that it's, where its age is. And so I think that that's a key data element for us to drive this standard that we're developing elsewhere within the unit. And then, CAL FIRE's funded us to do that and then to take it statewide. It's going to be pretty critical that we wrap our arms around the nature of all this fuel management work that's being done with a common understanding about what it actually is, because many of the shared geospatial databases that we see today, it's in the nicest possible way, it's like garbage in, garbage out. I don't think people trust the data.
I'd say, like, on our part, to add into that, we're currently actively working on 60 plus properties right now and another 200 in the pipeline. And this might be surprising. The number one reason we do not get something written with a discount is not because insurers do not believe in mitigation or that massive fuels work and massive hardening doesn't work. It's actually because there is complexity in the system. There's multiple brokers, wholesalers involved. There's channel conflict. One carrier is afraid of underpricing itself against a risk it just priced, maybe 6 months ago, which looks incorrect to their board. So I think there's actually a lot of changes that need to be made from a data and system perspective in terms of, like, the insurance distribution chain.
So I agree with all that. More data is better. Better modeling's better. What's the old aphorism about models? All models are wrong, but some are useful. But better is better and more is better. But there's enough data and enough modeling capacity out there right now for direct writers of home insurance and small business property insurance to take mitigation into account. I support the initiative to create a data commons, a place where all this data could be ported into and insurers could have access to it, and that's a terrific idea. But let's not let the perfect be the enemy of the good. When you think about it, when you get your home insurance policy renewed, or you get one for the first time, you're asked a bunch of questions by the insurance company. How old's your home? What's the roof made of? What's the heating system? How many rooms do you have? What are the materials on the siding of the house, right? They ask those questions to underwrite. They can also ask, have you done home hardening? Have you met the IBHS standard? Tell us exactly what you've done. Have you done a zero lot line? Have you done defensible space or defensible zero line? And so these are ways to collect that data. And yes, I take Joe's point about the CAL FIRE database not being perfect, but I think it's good enough for carriers then to begin to do a further inquiry as to when was that treatment done? What was the nature of the treatment? And then actually take that into account in writing insurance. So more is better, better is better, but we have enough that carriers can begin to start underwriting. And I think the projects each of us done has demonstrated that. So yes, let's do more, but let's not let the perfect be the enemy of the good, because people are in a crisis right now in terms of insurance availability.
I want to build on what Dave said, because that kind of echoes with some of our work, where we're seeing some of the biggest challenges are not so much data challenges, but education awareness challenges, and about how we create shared cultures of risk management. Wildfire risk reduction requires action across scales, across geographies, and we need a common attention on the risk, which is true for people on this call and listeners, but not as widespread throughout, like, the entire population. And we've seen in some of our work in the Southeast that what really kind of kickstarts a really positive feedback loop of investments in risk reduction and then insurability is when you have all the different stakeholders involved and bought into the risk management. So realtors understand what it means to have a hardened home and communicate those benefits. Insurance agents understand what it means for your pricing and ask you and get that information to your insurer. Community leaders understand what they need to be doing and undertake that work, right? And then when everyone's having that same shared understanding about the risk reduction, that's when we see things really start to kickstart. And I'd say that we're actually that's happening to some degree, but we're up against difficult headwinds, right? We face a housing supply challenge, and there's a lot of pressure to get homes up quickly. There's a lot of thinking that building fast and cheap is what's needed post-disaster and pre-disaster. And I think less of a shared understanding that affordable housing is safe housing, because if you don't build the safe housing, it's not insurable and it's not expensive to live in. And so we need to see that kind of change in cultural awareness too.
Yeah, and I would just build on that and add here, I think, and when I think about kind of a resource gap, I agree. I think a lot of the data and information there, yes, we need to continue investing and making sure we've got the right kind of updated information and data, as said, but kind of tied to that, and where Carolyn was just speaking to, I think part of this in the education piece is we need to make sure that there's continued community support for sustained investment, because as we've all been talking about here, it is not like we can make one investment and then we're done. And then we are somehow in this like static, resilient state. We have to make sustained investment and investment in operations and maintenance, which often, especially for local governments, is much harder to be able to fund and get the right funding in the right pocket to be able to do that, as opposed to some of the capital outlay. So I think one of the big key resources that I see kind of a gap around is actually being able to think about how we have those sustained investments, and especially for the ongoing kind of maintenance that needs to happen to sustain the benefits of mitigation.
Great. Thank you all for that. And, time is flying by here, and I want to be mindful of that. So to wrap up with a final question, what is next? And not necessarily for each of you in your own projects, but if you had to pick one next step that collectively California can take, or the insurance industry can take, or that each of us can take, what is the next brick that we have to lay to keep building this foundation?
I'll start it out because mine's probably the most insane. And if anyone on the call wants to work on something insane, I'm down. I think, honestly, one thing that could change the system is if there's some way to create mortgage financing, or a way to build into the future value of your home the cost of mitigation and insurance. And I think that honestly would be a huge save. We all know right now, if you don't mitigate your property, it's getting harder and harder to sell that home. Banks are not offering financing. That means only cash buyers. If there was a way to create a product that essentially said, I'm going to borrow against the future sale value of my property, and I'm going to use that today so I can do mitigation and get insurance, I think California does have one thing, which is incredible, and so do Colorado and all the places we're talking about. Very beautiful real estate that is high value, and you could do a lot of work today that could make that a sustainable future.
I was going to say something similar, but very much broader than that to what Andrew said, which is we need sustained funding and financing, as Nuantara was saying, for this type of mitigation work to keep it going. So creative ideas like he just shared, I think, are what we need to be thinking about.
Here's another crazy idea that I've talked about and I'm working on with PG&E and land trusts, and that is I think we need to create a new class of what I would characterize as resilience easements. So you have utility easements, you have conservation easements. Conservation easements are a tax benefit based on you signing on for a prohibition of doing a bunch of things. Utility easements essentially allow utilities to do work in corridors around the country for transmission distribution lines. I think that we need to sort of reimagine a set of tax incentives by creating resilience easements, which essentially incentivize landowners who own strategic topographically significant areas, that own lands that surround suburban areas, to be able to make investments in resilience, fuel clearing, et cetera, and to get a tax benefit for that. And it would not, although the work needs to occur in perpetuity, it wouldn't be a one-time incentive that then, you got to incentivize people to go back and do it every 3 or 4 or 5 years. And that requires sort of rethinking this notion about resilience easements, the notion of a conservation easement, which essentially says, I'm going to pay you money to do nothing ever, to I'm going to actually give you a tax incentive to do something and go back and do it every 3 or 4 or 5 years.
I love that. I would just add, and kind of double clicking on everything that has been said, I think it's really the funding and financing piece that is really needs attention. And I think building on what was said, I think it's creating a better and more actionable framework for how the funding and financing pieces need to fit together, and thinking about this in a little bit of like a cost share piece, because I think we are making investments across from private kind of individual business, homeowner perspective, through local governments, through state government, but I don't think they are as aligned. And as was described here in some of these examples, like there are ways that we could be more strategically aligning and incentivizing funding from across different actors towards this in a more consistent way.
I agree with all that, but I continue to be concerned that even with all of that, insurers are not going to take mitigation into account in their underwriting. So I would add to the list, enact Colorado Bill HB 1182 to simply require that the models take into account that which they can take into account, which is the demonstrated benefit of property, community, and landscape scale mitigation, as a way of making sure that homeowners and small business property owners and communities have a fighting chance to get a risk score that gives them a chance to actually get insurance written or renewed for their property.
Excellent. Thank you so much. And as audacious as they are, those are really inspiring ideas. And these are threads worth picking up and following up on. So with this, I will thank each of you for sharing your insights today. Thank you to our audience for joining us today. It's clear that mitigation can measurably improve insurability, but the real world ahead is scaling these solutions. Insurers have the data and tools to account for mitigation. Now we need the right standards, policies, funding, incentives to help put them into practice. So as you leave today, we hope these insights will help carve out clear next steps to take you with your own work. CWI is going to be considering our own efforts in this subject and whether we need to shift our approach. And we encourage you to keep in touch and consider us as a resource to supplement your own efforts. Links to the full recording and any resources discussed will be available on our website following this webinar. And as we continue to build upon these webinars and our convening programming, we'd love to hear your thoughts and feedback, as well as on today, as well as on other topics that may be interesting to cover in the future. So please take a moment to fill out a brief 1-minute survey once this webinar concludes. It'll just pop up on your screen automatically, and keep an eye on our website and social media for future webinar dates. Thank you again for your attendance and support for our CWI webinars, and we look forward to seeing you all next time. Have a great day, everybody.
Take care.